Imagine a company that sees its stock price just explode, right? Like over 160% in just a single month.
Wow.
Mostly thanks to partnering with, one of the biggest tech giants out there. Sounds amazing.
It does. Sounds like a rocket ship.
But here's the twist. The company
Yeah.
still losing money. So what on earth is really going on here?
Yeah, that kind of extreme contrast really makes you stop and think. You got to look past the headlines.
And that's exactly what we do here on the Deep Dive. We take the source material you send us, articles, data, research, and we try to cut through all the noise to find the key insights fast.
Get to the core of it.
Exactly. So today we're diving deep into Navitas Semiconductor, ticker NVTS. This is all based on a detailed analysis you've shared with us.
Okay.
And our mission really is to unpack these sources. We want to understand what Navitas does, what its potential might be, what huge challenges it's facing, and, what the market seems to be saying about it right now.
It's about getting that clear picture, the good, the bad, the potential, the risks, all laid out from the material.
Absolutely. And speaking of getting clear insights, we want to give a quick shout out to our sponsor, Stock Analytics AI. If you find these deep dives useful, please do show your support. Like this video, subscribe to the Stock Analytics AI YouTube channel. It genuinely helps us keep doing this kind of analysis.
It really does.
And there's a great member benefit too. For just Euro 4.99 a month, members can give us a ticker symbol.
Oh, nice.
Yeah, and we'll prioritize a deep dive analysis just for you. Could be a general company look, or maybe focusing specifically on recent earnings. It's a great way to get insights on the companies you're interested in.
That kind of tailored analysis, that can be super helpful when you're trying to figure out a specific company.
It really can. Okay, back to Navitas. As we dig into this company, there's this really interesting tension that keeps popping up in the sources.
Okay.
Can a relatively small company that isn't profitable yet truly compete with these trillion-dollar giants, especially when you've got these big global trade issues potentially bubbling up?
Right. That's a huge question. Scale versus innovation with geopolitics thrown in.
Exactly. We're going to circle back to that, tackle it right at the end, based on what the sources are telling us.
Sounds good. That really gets to the heart of the risk-reward situation the analysis points to.
For sure. And hey, if you haven't already, please hit that subscribe button so you don't miss future deep dives. All right, let's get into it.
Let's do it. So where do we start? Building that foundation, right? Understanding what Navitas actually is.
Right. First chapter, business understanding. The sources call Navitas a pure play, next-generation power semiconductor company. Okay, pure play. What's that mean here, and why are these next-gen chips important?
Okay, so pure play just means they're really focused, like almost entirely on one thing. In their case, it's these advanced power chips. Specifically, gallium nitride, they call it GaN and silicon carbide, or
GaN and SiC.
And their next generation because, well, they perform way better than the traditional silicon chips we've used for ages.
Better how, though? What's the actual advantage for, the user or the product?
It really boils down to efficiency and size. The source material highlights that GaN, for instance, can cut energy waste by up to 40%.
40%. That's a lot.
Yeah, and it can make the power parts like 3 times smaller. So think about your phone charger, right? Imagine it's smaller, not getting hot. Or an electric car charging faster, wasting less electricity.
Okay, I see.
GaN and SiC allow for higher power density. They switch on and off faster. Less energy just gets lost as heat. Navitas sells these under their brands, GaNFast and GeneSiC.
The sources also mentioned something about integration being important for GaNFast. What are they integrating?
Yeah, that's a key technical point they emphasize. For their GaN chips, they're not just selling the basic power switch, the transistor. They actually build the control circuits, the driver, sensing, protection, all onto the same piece of GaN.
Okay, so it simplifies things.
Exactly. It makes life easier for their customers designing products. Fewer parts, potentially better performance, better reliability. It's one of their main technical selling points, according to the analysis.
Okay, so they design these cool, powerful, efficient little chips.
Yeah.
How do they make money from it? What's the actual business model?
Right, so Navitas operates using what's called a fabless model.
Fabless, meaning
They don't own the incredibly expensive factories, the fabs where the chips are actually made. They do the design, the brain work, but they partner with outside companies called foundries to do the manufacturing. Like TSMC makes their GaN chips.
Okay. That must save a ton on upfront costs, but I guess it makes them dependent.
That's the trade-off, precisely. It keeps their capital spending much lower than companies with their own fabs. But yeah, they rely heavily on those partners. The sources definitely flag this as a risk supply chain hiccups. Maybe not getting enough chips if demand explodes, being subject to the foundry's pricing.
Makes sense. And the revenue itself. Where's the cash coming from?
Almost all of it comes from selling those GaN and SiC chips and related integrated circuits. The analysis mentioned $83.3 million for that in 2024.
Okay.
But here's a really important point from the sources. Where that revenue comes from geographically, it's heavily concentrated in Asia. China was like 60% of their total revenue in 2024.
50%. Wow.
Yeah, and Hong Kong specifically was 59% in just the first quarter of 2025. They get a tiny bit from licensing their tech, but it's really overwhelmingly chip sales, mostly into Asia.
That heavy Asia focus, especially China, I imagine that's going to come up again when we talk risks.
Oh, absolutely. The analysis highlights it as a major factor to keep in mind.
Okay, so where are these chips actually ending up? What kind of products?
They're targeting some really big growing markets, things like fast chargers for phones and laptops, consumer electronics, electric vehicles, what they call e-mobility, also new energy systems like solar power inverters, industrial uses, and this is a big one now, AI data centers.
AI data centers.
Yeah.
Makes sense those things need a ton of power efficiently.
Exactly. So their technology really taps into these huge global shifts. Electrification, the push for energy savings, and yeah, the absolutely massive power demands of AI.
So the industry itself has potential.
Definitely. The source material connects their tech directly to these big trends. And because of that, the overall markets for GaN and SiC, they're expected to grow really fast. Some forecasts mentioned in the analysis show compound annual growth rates, CAGRs, anywhere from, say, the low 20s to over 40% per year for different segments.
That sounds pretty good for the underlying industry.
It suggests the basic playing field Navitas is on has a strong tailwind for the long term.
Okay, promising market, interesting tech. But who are they fighting against? Is this an easy space to just jump into?
No, definitely not easy. The competition is fierce. They're up against absolute giants in the semiconductor world. Think Infineon, Texas Instruments, ST Microelectronics. These companies have massive scale, tons of resources, existing customer relationships going back decades.
Huge incumbents.
Right. Plus, they also compete with other specialists like Power Integrations and another big name in SiC, Wolfspeed. In fact, the sources even mention Navitas is involved in a lawsuit with Wolfspeed over an alleged breach of contract.
Ooh, okay. So how does a smaller company like Navitas even try to compete with those behemoths?
Their angle, according to the analysis, is being nimble, being that pure-play specialist focused just on GaN and SiC. They lean heavily on their technical innovation, that integration we talked about, their patents. They have over 300 patents mentioned.
So innovation versus scale.
Pretty much. But competing against companies with their own factories, deep pockets, and long histories is a constant uphill battle mentioned in the sources.
Okay, let's quickly recap this section then. What do they do? How do they make money? Is the industry promising? And what makes it hard for others to copy them?
All right, based on the sources, Navitas designs and sells advanced GaN and SiC power chips, making things smaller, faster, more efficient. They make money mainly selling these chips, especially into high-growth markets, heavily weighted towards Asia. Yes, the underlying GaN-SiC industry looks very promising long-term, driven by big trends. And what makes it hard to replicate? It's a combination of their specialized technical know-how, their specific chip designs protected by patents, needing to prove reliability. They even offer a 20-year warranty on GaN, plus the long time it takes to get designed into customer products, and needing access to that cutting-edge manufacturing.
Got it. That paints a clear picture of the business itself. Now let's shift gears and look at management evaluation. Who's actually steering this ship, and how have they done so far?
Well, the company was co-founded by Gene Sheridan, who's the CEO, and Dan Kinzer, who was key on the tech side and is now an advisor. Gene Sheridan has a long track record in power semis, led a company called Bridgeco, was a VP at International Rectifier. Yeah. And Dan Kinzer, he's got decades in R&D, holds something like 180 patents. He's even in the ISPSD Hall of Fame. That's a power semiconductor conference. So deep tech roots there. The CFO is Todd Glickman, and the board. It includes people from their early investors and the SPAC that took them public, which is pretty typical.
How have they handled bumps in the road? The sources mentioned some headwinds.
Yeah, they definitely faced challenges, particularly in 2024. They acknowledged an industry slowdown, and their response, according to the analysis, was to focus on managing expenses, tighten the belt a bit, and really double down on trying to win new customer designs for future products.
And more recently?
More recently, Q1 2025 revenue took that sharp dive we'll talk about later. In response, they announced more cost cuts, including layoffs. So it shows they're reacting operationally when revenue drops.
Okay. What about things like transparency, ethics?
The sources suggest they follow standard practices for public companies, SEC filings, earnings calls, investor days, that kind of thing. They also seem to promote a positive ESG profile, highlighting they're the first carbon-neutral semiconductor company.
Any red flags?
The only specific thing mentioned in the sources is that Wolfspeed lawsuit, which is really a legal dispute at this stage, not necessarily an ethical issue per se.
Okay. So the big question for management, are they capable? Are they honest? And are they focused on creating value for shareholders?
Based purely on what's in the source material.
Yeah.
Capable. Seems so, especially given the technology they've developed and landing big deals like NVIDIA. Honest, they seem transparent in their communications, following the usual channels. Now, shareholder-oriented, that's where it gets a bit more complex, looking at the data.
Complex how?
Well, on one side, their strategy seems geared towards long-term value, targeting those big growth markets, aiming for profitability, EBITDA break-even by 2026, is a stated goal, investing heavily in R&D. That all points towards building future value. And even raising money recently using their stock program, the ATM, after the price popped, you could argue that was a smart financial move to fund growth when the shares were higher.
Okay, but there's another side.
Yes. The analysis highlights a pretty significant pattern of net insider selling over the last year. We're talking over 11 million shares sold by insiders versus bought.
11 million net sold. That's quite a bit.
It is. And what's particularly noted is that this includes sales by several directors and entities linked to those early investors, specifically after the stock jumped in May and June 2025 following the NVIDIA news.
The timing is key there.
Right. Now, insiders sell for lots of reasons: personal finances, diversification. But that pattern, especially the timing after good news and a price surge, is definitely a data point that investors look at. It could be seen as just taking profits or, well, potentially a less positive signal, depending on your perspective.
Okay. That insider selling, particularly timing, definitely adds a wrinkle when you're thinking about shareholder alignment. How are they actually using the company's money day to day? Capital allocation.
Yeah, it's heavily focused on R&D, investing in the future. R&D spending is huge relative to their current revenue. The sources cited over 90% in 2024 and Q1 25.
Wow, over 90% of revenue back into R&D.
Yeah. Since they're fabless, their direct spending on equipment and factories is low, but they do make strategic investments, like putting $20 million towards securing SiC wafer supply. They've also used acquisitions strategically, buying GaN and SiC to get into the SiC market. And, as expected for a growth company burning cash, no dividends, no share buybacks.
And the returns on those investments so far, things like ROIC,
Right now, they're negative. The sources put ROIC around minus 13%, ROE somewhere between minus 12% and minus 23%, ROA maybe minus 11% to minus 20%.
Okay, so the investments haven't turned into accounting profit yet.
Not yet. And that's expected at this stage. The analysis really frames it as a bet on the future. Capital is going into R&D, acquisitions, trying to win market share. Whether that allocation is effective really depends entirely on if it generates significant revenue and profit down the road. Raising that recent $50 million through stock sales fits into its funding to keep making those bets.
So, pouring money into growth, strong tech, but no profits yet. Let's dig into the numbers more with financial health. What did the snapshot look like in early June 2025 after that big stock move?
Well, the market cap jumped significantly, somewhere between $1.2 and $1.5 billion after the NVIDIA news. Since they aren't profitable, the usual PE ratio isn't meaningful, it's negative. Price to book was around 3 to 3.5, suggesting the market values their potential above their current asset book value. And price to sales was pretty high, around 15 or 16 times their last 12 months revenue.
Okay, let's talk about that revenue. Last 12 months, around $74 million. But the sources flagged a recent drop, didn't they?
Yes, and this is really important. In the first quarter of 2025, their revenue was just over $14 million. That was a big drop, almost 40% lower than the same quarter the previous year.
Ouch. Why the drop?
Management pointed to softness in some key markets, mobile, EV, industrial, and their forecast for the next quarter, Q2 2025, suggests things will be basically flat from Q1, around $14–15 million again.
So the growth trajectory isn't smooth.
Not recently, no. They grew really fast from just $12 million back in 2020 up to $83.3 million in 2024. But this recent performance shows they're definitely sensitive to cycles in their end markets. Future growth really hinges on converting that big pipeline. They talk about, the sources mentioned, $450 million in design wins in 2024 and a $2.4 billion identified pipeline into actual booked revenue.
And profitability. We know they're unprofitable. Just how bad is it?
Well, their gross margins, the profit just on making and selling the chips, are actually decent, around 34–39%. So the basic cost of goods is under control.
Okay.
But their operating and net margins are deeply negative. We're talking in the range of -100% to -180%.
-180%. Wow. How?
It's because those operating expenses, primarily R&D, but also sales and marketing, are just so high compared to the current level of revenue. They really need to grow revenue significantly faster than those costs to achieve operating leverage and eventually cross into profitability.
So it's the R&D spend mostly.
Primarily, yes. And it's worth noting, as the sources point out, while the operational loss is consistently large, the final reported GAAP net income can jump around a bit. That's due to non-cash, non-operational things like accounting adjustments for earnouts related to past acquisitions. So the bottom line number can look volatile, but the underlying business is consistently losing money on operations right now.
Okay, deep operational losses. But what about the balance sheet? Is it strong enough to handle that cash burn and R&D spending?
Actually, yes. This is a major positive highlighted in the analysis. Navitas has a very strong balance sheet.
Really? How so?
They have very little, practically zero, interest-bearing debt. And they have way more cash than debt. The sources mentioned around $75 million in cash at the end of Q1 2025. Their liquidity ratios, which measure ability to pay short-term bills, are excellent. Current ratio around 5.6, quick ratio around 4.5.
What do those high ratios actually mean, like in simple terms?
It means they have more than 5 times the amount of readily available assets, cash, money owed by customers, inventory compared to their bills coming due soon. So it gives them a really solid cushion, financial flexibility to keep operating, keep funding that R&D, even while they're losing money.
Okay, that cushion is important, but are they burning through it quickly? What's the cash flow situation?
Yes, they are burning cash. Free cash flow is consistently negative. The sources cited about a $13.6 million burn in Q1 2025 and roughly $66 million burned for the full year 2024. So they are definitely relying on that cash pile and on raising new capital like that recent $50 million stock sale to fund everything until they can start generating cash themselves.
Okay, let's synthesize the financial health then. Profitable, strong balance sheet, volatile earnings, too much debt.
All right, summary from the sources. Profitable. Definitely NO right now. Operational losses are significant and ongoing, though reported net income can be noisy. Strong balance sheet. Absolutely. Yeah. Yes. Very strong liquidity, minimal debt. Volatile earnings. Yes, the reported GAAP number can be due to non-operational items, but the operational trend is consistently negative loss. The challenge isn't debt. It's turning that balance sheet strength into operating profit and positive cash flow.
That low debt high cash point is really critical context. Okay, let's move into the second half now, starting with market sentiment. That incredible stock surge we opened with, 164% in May.
Right.
What was the main driver again?
Overwhelmingly, it was the announcement of that NVIDIA partnership near the end of May.
Right.
The market saw that as huge validation for Navitas' tech, especially targeting the AI data center market, which is just booming and everyone's focused on. It completely shifted the perception, at least temporarily, and sent the stock flying to a 52-week high.
Okay, so perception clearly turned very positive very quickly. What about the professional analysts? What are they saying now?
Well, the consensus rating is generally a buy, but interestingly, the price targets analysts have set are all over the place. The sources mentioned a really wide range, from as low as $1.50 to as high as $6 a share. The average target in early June was still sitting somewhere below where the stock actually peaked, maybe around $3.40 to $4.06.
Huh. Why would the average target still be below the recent high price after such big news?
It's a great question. The analysis points out that even after the NVIDIA announcement, some analysts, Needham and Morgan Stanley were mentioned, actually lowered their price targets.
Lowered them. Why?
They cited ongoing risks, things like general market volatility and, importantly, potential tariffs. Others, like Rosenblatt, did raise their targets. So you have this divergence. It suggests that while everyone sees the NVIDIA deal as a massive opportunity, analysts are still grappling with how to weigh that potential against the company's current lack of profits, the timeline for actually getting revenue from that deal, and these significant external risks.
So the NVIDIA news wasn't a magic bullet for all analysts' concerns.
Apparently not for everyone, no. They're still factoring in the challenges.
What other recent news played a role, besides NVIDIA?
Well, there was the Q1 2025 earnings report itself. It met the lowered expectations, but it also confirmed that big year-over-year revenue drop we discussed. They also announced some new products aimed at key markets, like a reference design for a 12-kilo AI power platform, and talked up their ongoing reliability testing. And that capital raise using the ATM program was reported generally seen as a sensible move to bolster cash. But honestly, nothing came close to the impact of the NVIDIA news. That just dominated everything.
You mentioned something earlier, too, that might have amplified that huge stock move.
Yeah.
Beyond just the NVIDIA excitement.
Right. The sources highlight that Navitas had pretty high short interest leading up to the announcement. Around 20% of the publicly available shares were sold short.
20% is significant.
It is. So when that massive positive news hit, a lot of those short sellers likely scrambled to buy shares back to cover their positions and limit their losses. This flood of forced buying on top of new investors jumping in because of the news creates what's called a short squeeze. And that can dramatically inflate the price move, maybe beyond what the news itself might warrant fundamentally.
And lots of options trading, too, suggesting more speculative interest.
Exactly. The sources mention very active options trading, which usually signals a high degree of speculation, and differing opinions among traders about where the stock is headed next adds to the volatility.
Okay, interesting dynamics. Let's look at who actually owns the stock and ownership structure. Who are the main holders?
Yeah.
Institutions, insiders.
Institutional ownership is quite significant, around 53% according to the sources. Big names like BlackRock, Vanguard, State Street are in there. The analysis also specifically calls out that major early investors, venture capital firms like Atlantic Bridge and Capricorn, plus the original SPAC sponsor Live Oak, are still among the largest shareholders. And importantly, people connected to these firms are on the Navitas board, so their actions matter.
Okay, so big institutions and early backers hold a lot. What about the insiders themselves, management directors?
Yeah, this is that point we touched on earlier. The analysis emphasizes significant net selling by insiders over the past year. More than 11 million shares sold compared to bought.
And the timing again.
Critically, yes.
Yeah.
The sources specifically identify sales by multiple directors and entities representing those early investors. Names like Ranbir Singh, Brian Long, Richard Hendricks, SiC Power LLC were mentioned executing substantial sales after the stock rallied in May and June 2025. Again, insiders sell for many reasons. But that pattern of net selling, especially by early money and directors right after good news and a price spike, it's a data point investors definitely notice. Could be simple profit taking, could be viewed less favorably. It just adds to the picture.
So institutions are big holders, but insiders, particularly those tied to early funding, have been net sellers, especially recently. Is ownership overly concentrated anywhere?
Doesn't seem like it. The sources suggest ownership is reasonably spread out. No single entity has majority control. But the influence of those large institutions and early VCs, particularly through their board seats, is certainly a factor.
All right, let's pull everything together now and look at the overall picture and risk assessment. Think of it like a SWOT analysis based on the sources. What are Navitas' core strengths?
Okay, strength. Top of the list is their specialized tech leadership in GaN and SiC. That integrated GaN-fast design is key. They have a strong patent portfolio protecting that tech, and they emphasize their proven reliability track record. Landing major partnerships, especially NVIDIA, is a huge strength. And as we discussed, that very strong balance sheet with minimal debt is a definite plus.
Okay. Now, the flip side. Weaknesses. Where are they vulnerable, according to the analysis?
Key weaknesses start with the fact they're currently unprofitable and burning cash. That means they depend on their existing cash and potentially more fundraising. The fabless model, while saving capital, creates those supply chain risks and dependencies. They're also much smaller than many competitors, which can mean resource gaps. Those high operating expenses, especially R&D, are a major drag on profitability right now. And that heavy revenue concentration in Asia, particularly China, is a significant vulnerability. Plus, we saw that recent sensitivity to market downturns in the Q1 revenue numbers.
Got it. What about the opportunities? If things break their way, what's the potential upside?
The opportunities are potentially massive. It really centers on the huge long-term growth projected for the GaN and SiC markets overall. These are driven by unstoppable trends like vehicle electrification, the need for greater energy efficiency everywhere, and of course, the AI boom.
Specific areas.
Yeah, huge potential in expanding further into AI data centers, building on that NVIDIA win, big opportunities in electric vehicles, both onboard chargers and infrastructure, renewable energy like solar inverters. There's also the ongoing opportunity to simply displace older, less efficient silicon technology across many applications. And they benefit from the broader global focus on sustainability.
Okay, massive potential market. Now the final piece, threats. What are the big external factors that could really hurt Navitas?
Number one is probably the intense competition from those huge established semiconductor companies who are also investing heavily in GaN and SiC now. They won't give up market share easily.
Right, the giants.
Exactly. And then, critically, the sources spend significant time on the threat from U.S. tariffs and the broader trade tensions, especially involving China.
Okay, let's unpack that tariff threat. How exactly does that impact a company like Navitas, given their model and where they sell?
Right. So the sources talk about potential new U.S. tariffs planned for 2025, which could hit various imports, possibly including things from China. And there's always the risk China retaliates. For Navitas, being fabless means they rely on manufacturing partners, mostly in Asia. And they sell a huge chunk of their product into China and the rest of Asia. So they're exposed on multiple fronts.
Ah, so?
Well, tariffs could directly increase their costs if duties are slapped on the silicon carbide wafers they buy, or the chip packaging and testing services they get done in Asia. Tariffs could also dampen demand for their chips if their customers, who might build the final products like chargers or power supplies in China, face higher costs or find it harder to sell those products into the U.S. or other markets due to tariffs.
So cost increases and demand destruction.
Potentially both. Plus, there's just the general risk of supply chain chaos if trade routes get disrupted. And it could shift the competitive balance if some rivals are less exposed to these specific trade flows. The analysis is very clear. Navitas has high revenue concentration in Asia, especially China, makes this whole tariff and trade tension issue a particularly significant threat for them.
That sounds like a really major, potentially unavoidable external risk. Anything else on the threat list?
Yeah, the usual suspects too. The general economic downturns or market volatility like they saw in Q1, the risk that technology evolves rapidly and maybe leapfrogs them, the risk of losing a key customer or design win, and those ongoing IP legal battles like the Wolf Speed lawsuit.
Okay, quite a list of challenges and threats to balance the opportunities. We've covered a ton. Let's try to wrap this all up in the conclusion.
Okay, so synthesizing the analysis from the sources, Navitas Semiconductor looks like a clear technology leader in its niche. It's positioned in markets AI power, EVs, solar, that are set for explosive growth over the next decade or more. They definitely have strong points. The tech itself, the IP, landing crucial partnerships like NVIDIA, and importantly, that solid balance sheet with very little debt.
But there's always a but.
There is. They face really significant hurdles. They're not profitable yet. They're burning through cash. They're fighting against competitors who are orders of magnitude larger. Their fabless model creates dependencies. And maybe most critically right now, their heavy reliance on Asia for both manufacturing and sales makes them extremely vulnerable to macroeconomic swings and those geopolitical risks, especially potential U.S.-China tariffs. And that pattern of recent insider selling is also out there as a data point.
So let's connect back to that initial hook, the stock surging 160%, even while the company's losing money. What did our deep dive reveal about that apparent contradiction?
It really showed that while the NVIDIA partnership is undeniably huge news, it's massive validation and opens a critical door into the AI market. That dramatic stock rally wasn't purely driven by fundamentals or the near-term financial outlook. The analysis strongly suggests it was significantly fueled by market dynamics like speculation and that short squeeze we talked about.
So the underlying issues didn't just vanish.
Exactly. The company still faces all those fundamental challenges. The tough path to achieving sustainable profitability, executing flawlessly against giant competitors, converting those design wins into substantial revenue fast enough, and navigating these major external threats, particularly the tariff risk that some analysts specifically flagged, even while the stock was rocketing upwards.
So the core question that emerges from all this source material seems to be, can Navitas' impressive technology and the clear momentum from deals like NVIDIA actually overcome the current unprofitability, the execution risks, the intense competition, and these looming external threats like trade wars?
That really is the central question, isn't it? It encapsulates the entire investment thesis, or the risk, depending on how you look at it. The sources paint a picture of a high potential but also high risk growth story. Success hinges on future execution in what's clearly a very challenging global environment.
Which leads us to our final provocative thought for you, the listener, to chew on. Considering the immense potential upside in these future markets, AI, EVs, solar WART, but weighing that against the very real risks of fierce competition, ongoing losses, and escalating trade tensions, is Navitas a calculated bet on disruptive technology worth taking? Or does it serve as more of a cautionary tale about how even great tech needs to prove it can overcome significant operational and geopolitical hurdles to truly succeed?
A question that really requires carefully weighing both sides of the scale, the extraordinary opportunities and the significant risks laid out in the analysis we've discussed.
Well, we hope this deep dive into the materials you provided has offered some valuable insights and context around Navitas Semiconductor.
Our goal, as always, is just to help you cut through the noise and get to the core information efficiently.
And remember, please subscribe to the Stock Analytics AI YouTube channel for more deep dives like this one. And if you want a prioritized analysis on a specific ticker you're watching, consider becoming a Euro 4.99 a month member.
Yeah, it's the best way to get the analysis focused on what matters most to you.
Okay, finally, just a quick but very important disclaimer.
This discussion is for informational and educational purposes only, based solely on the source material provided. It's not financial advice, a recommendation, or an offer to buy or sell securities. Investing involves significant risk, including loss of principal. We've presented insights from the sources, but market data and financials are specific to the dates referenced. Conduct your own thorough research and consult with a qualified financial advisor before making any investment decisions. Past performance doesn't guarantee future results. Do your own research. DYOR.